In volatile times, the best thing to do is try to ignore the noise and try to look through to the other side. If you're accumulating assets for retirement, maybe use this as an opportunity to just, if nothing else, just continue buying at just lower prices, or maybe putting more dollars into your investment portfolio to take advantage of lower prices. But one of the criticisms of that coaching, it comes from people who are either retired or they're getting ready to retire. And they're saying things like, I can't afford to wait for the market to rebound, or, holding on during difficult times was fine when I was 35 or 40, but now I'm 60 or 65, I'm getting ready to retire, and that advice does not hold for me. And so in this video, I wanted to actually look into that, thought pattern and figure out, does that make sense for somebody who's retired? And what I wanted to do is look at a really, really bad historical period for stocks and bonds, a really bad starting point, and look at a portfolio of stocks and bonds that would be a typical mix for somebody who's retired. It's about 60% equities or 40% fixed income, and wanted to compare using that portfolio to start withdrawing money every year for retirement, compare that portfolio against a portfolio of cash and a portfolio of short-term fixed income instruments. And really the assumption that I'm trying to challenge is, I don't want to participate in any more volatility or drawdowns. I want to be in safe assets for my retirement and use that to generate income for me in retirement. And what you'll see as I go through this, the visuals that I'm about to share with you, is it sort of changes your view, or I think it should change your view on what risk is. And I'm going to elaborate on that. But as always, I like to use visuals to kind of help bring the point home. So I'm going to share my screen with you here. So I used an online tool. It's free. You can use it yourself if you want to. It's called Portfolio Visualizer. And I put my assumptions in the bottom part of the chart here, but we started with $1 million back in 2008. This is right at the onset of the great financial crisis. And we had a retiree who was taking $40,000 out of their portfolio every year, adjusted for inflation. So going from 2008 and fast forward through until today. And so the retiree that saw what was happening in 2008 and maybe turned to their advisor or to a friend of theirs, said, I can't handle being in the market right now. It's just too volatile. I need to be in safe assets. And they maybe decided very early on in that process that they were going to move to a safer portfolio like cash or short-term bonds. And that idea made sense, or it seemed to work out for the first few years of the retirement. But once you get past around 2011 to 2013, you see that the growth of that portfolio, that 60% equity, 40% fixed income portfolio, started to overtake the growth that retiree experienced in the short-term fixed income portfolio or the cash portfolio. Even after withdrawals, and even after that significant drawdown that we saw in this type of portfolio in 2008, the subsequent growth that occurred, following that instance in 2008, it didn't take very long for the stock and bond portfolio to overtake the cash portfolio and the short-term fixed income portfolio. And then we fast forward through to today. And of course, we've seen, the 60-40 portfolio has come off of its highs. But, if you look at it over the span of that time frame from 2008 to today, that somebody who's invested in a portfolio like that, even through the volatile times that we've seen in 2008, in 2020 with COVID, and even today, that somebody who accepted a little bit more volatility was able to sustain their retirement income with inflation adjustments through that time frame, and they have more retirement assets to show for it today. So it just sort of takes the idea of risk and it turns it on its head. And I certainly empathize with people who are approaching retirement right now. They're in retirement, they're taking income from their portfolios, and like, I can't really wrap my head around owning a portfolio that's this volatile if the idea is to generate income. And so when I have this conversation with people, I say, look, let's zoom out and think about risk in the broader context. And as I showed in that chart, there is a risk certainly in the short term to owning a portfolio of assets that moves around like stocks and bonds. But if you're looking over a retirement period, which for me is like a 30 to 40 year time clip, we also want to think about the risk that, your cost of living rises and your portfolio can't keep up and continue to put cash in your bank accounts in order to offset those higher costs of living over time. So you have to think of risk in a different way. And so hopefully this visual has kind of helped bring that home for you. And here are really the big takeaways that I'd like to finish with. So really, risk takes on different meanings depending on your perspective. So from the perspective of somebody who's invested right now, If they invested at the beginning of the year at all-time highs and they had no plan, certainly they're feeling the risk right now of the downside. But for somebody who's investing over a longer time horizon, and now I want to narrow in on that retiree, we got to think about risks right now, which are your emotions and making sure that you're comfortable in the mix of stocks and bonds that you hold in your portfolio, that it's serving a purpose for you. We have to be mindful of those things, but we also want to be mindful of the long term and make sure that what we're doing is prudent, so that as costs of living rises over the long term, that we've got a plan and a posture in place that allows you to continue to take rising paychecks through a 30 or even 40-year retirement. The second big takeaway is certainly you can feel the feelings of this year and everything that's going on in the markets and in the world. But my encouragement or my coaching is do your best not to act on those feelings. It's absolutely normal. We all feel those feelings. Even your advisor is nervous about what's going on in the markets, right? Like, I don't love to see things that are going on around the world, the geopolitical risks, and people in parts of the world that are in danger. It's certainly scary, but I always try to bring it. I try to zoom out and look over long time clips of history, and certainly having a financial plan helps with that, so that you can put sort of that broader, longer term into perspective, and that it helps you sort of think, okay, there is a reason for me to hold a portfolio like this. It is designed to create income for me that's going to last for a long time, and in order for me to have that comfort or have that the potential outcome that you have, that higher income that's able to rise with a portfolio over time, you need to be willing to accept some more volatility than being just in cash or in short-term treasuries. And then the last point, which is kind of a repeat, but certainly having a plan first, before encountering risks makes a huge difference. So the idea here is have a plan first and then build your portfolio. I've written it before, but I say that a portfolio without a plan is an abstraction, meaning it's just sort of a guess. We're owning something, and at the first sign of trouble, if we haven't planned properly, if there isn't a really good reason for us to hold the portfolio assets that we hold, we're very, very likely, or at very least in much higher danger of making a big mistake and panicking out at the worst possible time. So my encouragement is to have a plan and then build your portfolio. And in the case of this retiree, that person, if they needed that amount of income, they wanted it to rise over the course of their retirement years, starting from a very, very bad time in history in 2008, them having a plan in place hopefully would have allowed them to see through holding that portfolio even through that that difficult starting period, so that they could have stuck around for the higher returns that they've been experiencing over the past decade or so. So I hope this video is helpful. If you like it, give it a thumbs up, and I will speak with you soon. Take care.